Last session in chapter number 5, we looked at a basic understanding of profits and profitability and break even. And now it's time for us to start to ask the question, will our business be profitable? How much capital infusion am I going to need to put into my business, whether it's through equity financing or debt financing? So let's begin to look at forecasting our financial plan for the future. And when we talk about forecasting itself is primarily associated with both forecasting certain economic conditions like macro conditions such as interest rates, but it primarily refers for the small business to sales itself. Let me define a term here that you may or may not be familiar with before we proceed, and that's the term pro forma. Pro forma merely means an estimate based upon certain assumptions that we make. So pro forma is always looking into the future and saying this is what we anticipate or expect it to be. It also is folding in certain assumptions as to what things might have looked like if something else had occurred. For example, sometimes banks will require a pro forma statement, say, okay, take your current financial statements and assume that you had gone out and instead of borrowing $100,000, you had somebody who gave you equity of $100,000. What would the results have been with respect to the actual company itself? And so that's a pro forma. That's an estimate based upon that. When we talk about forecasting is obviously a quantifiable estimate of our future demand, our sales, and forecasting in business is the process of estimating that for our products and services so that we can come up with what we think is a reasonable guesstimation for revenue. And even for the financial manager, it may also require estimates, as I said before, future interest rates. So there are basically six steps to a forecasting process. Determine the type of model, determine the forecast horizon, select one of those models, evaluate those models, apply the models, and then monitor and control the models and adjust if necessary. So let's look at each of these six in a little more detail. Number one step in the process is determining the type of model to be used. So you're really going to be asking 6 questions of yourself. Who's going to be using the forecast and what information do they require? If you're going to a bank for a loan, obviously they're going to have a certain amount of information. The Small Business Administration, if you're going for an SBA loan, is going to have a certain information that's going to be necessary. Other private investors may have certain information that they're looking for. So it's important to understand what all your information is. So as you are pulling together your forecast, you are pulling together all the component pieces that everyone's going to need. You also have to ask the question, how relevant is the historical data? In other words, when you're going to be looking at trendings and you're going to be looking at sales of last year or the year before or whatever the periods that you're going to be looking back, are they really relevant to your forecast that you're going to be putting together for the future? And also, what's the availability of that data? Questions 3 through 6 really are all kind of interrelated. How accurate does the forecast have to be? What's the time period of the forecast? How much time do we have to develop the forecast? And what's the cost or benefit, the value of this forecast? The more accuracy that you're going to be wanting to get in these forecasts itself, that means that there's more variables that you're going to factor in to your forecast itself, and the more variables mean that there's more cost to acquire and accumulate the information necessary for that. So the first step in your process of forecasting is to determine the type of model to be used. And then you also need to, the second step is determine the forecast horizon. Now, there's an inverse relationship between the accuracy of your forecast and the time horizon for your forecast. It just makes sense. The longer out in the future you look, the more inaccurate the forecast is going to be, just because of all the impact of all the various variables out there. The time horizon that you look at for your forecast should be at least as long as the time period of the strategic plan. For example, a manufacturing facility that's looking at the necessity of building another manufacturing plant, they are going to have a much longer strategic plan, and the forecasts need to take that into account because of just the build-out costs associated with something like that. Someplace where there's a very quickly moving of technology and turnover of technology. Let's take, for example, iPhones, which there seems to be a new one that comes out every 6 to 12 months. The forecasting for that is going to be in a much shorter time period because of the fact that there's this turnover in technology that is happening. And that's part of the product life cycles, which really influence the length of forecasts. The textbook makes reference to milk sales that can have a very long forecast because demand has a tendency to be rather constant out there. Once you determine in your forecasting as step number 2 in the forecast horizon, then you go and begin to select one or more forecasting models. And again, which model you choose is going to be dependent upon those 6 questions we asked ourselves initially. Is what information is required? How relevant is the history? How accurate does it be? How far forward do we want to go into the future? Really, what's it worth to us to spend a lot of time of trying to influence or to fine-tune this? And sometimes you will find even in a business, and it depends upon the business itself, that the business may get broken up into component pieces, and each of those component pieces may have different forecast models that it makes sense to apply to those component pieces. For example, a retailer trying to forecast sales may break out its electronics department much different than its women's clothes department, for example, with respect to just forecasting what sales will be. Once you do that in the process, step number 4 is really to evaluate the models. And as part of evaluating the models, you want to compare the accuracy of the forecasting models by what's called the mean absolute deviation, or MAD, and we'll just look at that in just a minute here. Remember that the models that you employ are to assist you as the forecaster. Don't ever just plug something into a formula and let the computer, in essence, dictate it. You always want to step back and give it the smell test to see if it makes sense. Also, sometimes there are some factors that are very difficult to put into a forecast, or the forecast methodology you're using doesn't really take it into account. For example, if there's overarching market and economic conditions that you are anticipating, you may have to adjust the forecast based upon that. Also, as those conditions start to unfold, you may actually have to go back and just keep reevaluating what your forecast is out there. Step number 5 in the process is, once you evaluate the models, you then apply whatever that chosen model is. And of course, how you put that into place is going to determine your future requirements. The application of the model and the specific units of measurement are going to that your models are going to generate are really going to be used by different parts of your company in different ways. For example, marketing is going to come back, and when you talk about forecasting into the future, they're going to want to know really what the demand is of that product, and they're going to want it by product line. For production, for manufacturing, of course, they're going to want to know what the number of units are. They don't particularly care about the dollars of sales. They want the units that they're going to be responsible for. Finance, of course, is looking for the dollars. They want to see how that all translates. And personnel, of course, is going to want to know, well, what are going to be the people requirements and the skill sets that are going to be necessary based upon whatever the forecasts are. Step number 6 in the forecasting process is to monitor and control the model. Models should allow us to develop controls in a 3-step process. First of all, it really allows us to determine and to implement standards that we're going to be looking at to say, how are we doing our actual versus what we forecasted, whether it's production or whether it's dollars or production units or whether it's dollars or whatever the standards that are that we have put into place. Also, it really, once we do that, then we can measure our actual performance that against this standard and adjust it as necessary. Take corrective action. If we're finding that our forecasts are off, we can adjust our forecasts. If we're finding that maybe there are inefficiencies that are occurring within our organization, then we can zero in on the inefficiencies and address them. One of the things that we should understand is when the forecast itself no longer allows the manager to be able to do these kind of things, then you need to go out and rework the forecast. Forecasts are meant to be a tool for use, not the Bible that you put into concrete and it just stays there forever. So let's talk a little bit more. Let's go back to step number 1 of the process, where we talk about really choosing the types of forecasting models themselves. And there are really 3 types of forecasting models, 3 basic categories that models fall under. Number 1 is a judgmental model, which uses qualitative methods. Number 2 is a time series model, which is very much crunching numbers using quantitative methods. And then there's a third method that we'll kind of mention briefly, which is the causal models, which uses cause and effect methods to say, well, if this happens, then we expect this to happen. So let's look at the judgmental models first and kind of get an understanding for some of the kind of models that are out there. Judgmental models are qualitative and essentially use estimates based upon expert opinion. In other words, those who are closest to that particular aspect of the business quite often have a pretty good feel and their thumb on the pulse of that. Sometimes you could refer to this as gut feel. For example, the sales force quite often really understands what is happening dynamics-wise with respect to what's happening out there in their industry themselves. So a judgmental model may be going out and doing a survey of your sales force as what do you expect the change in your particular on your particular portfolio, those that you are responsible for, and what do you think the forecast will be? Why do you think there's going to be adjustments up or down, expansion or contraction? That's an example of a judgmental model. Another one may be just going out and doing surveys of customers. For example, if you're getting ready to come out with a new product or a modification to an existing product, you may go out and ask your customers some questions about that to be able to gauge their receptivity to looking seriously at buying that or continuing to buy that particular product. There's also historical models, which is most appropriate for firms that have several outlets. Introduction of a new product which has characteristics similar to previous products would fall under this one, and this allows you to really kind of take what has happened in the past and project it to make assumptions about what will happen in the future. There's also market research studies that could be surveys, tests, observations, where you take that market research and then try to, in essence, overlay it to develop a forecast for demand for the projects. There's also another method called the Delphi method, which is uses a panel of experts to obtain a consensus of opinion. And the way that this is usually used is when there's something brand new out there that there's just no data to be able to go out and to really use as your basis for developing a forecast. For example, if there's a brand new product that your customers have never seen and never had exposure to before, you wouldn't necessarily go out to your existing customer base that are buying a different product and ask them about that product. Maybe, just depending upon what the benefits are to them. You may go out and, in essence, to keep that product close at hand, so to speak, go out and kind of choose some experts out there to say, what do you think? And quite often this panel of experts are not brought into the same room. They're kept separated from each other so that there's not any of that spillover effect of influence of one person's perspective influencing another person's perspective. So that's the first type of models that are out there, the judgmental models. The second type of forecasting models that I referenced out there are what are called time series models. And these models usually will use historical records, what's happened in the past, which is usually readily available, and they'll use that to come up with a forecasting into the future. And using time series models basically is making an important assumption is that what has happened in the past can give some sort of accurate predictor of what's going to happen in the future itself. And we'll talk about some of the various time series models here in just a minute that will sometimes take into account some of those accuracy predictors, because there's, as we know, there's not always a one-to-one correlation. What happened last month doesn't always mean that's what's going to happen next month, and there are other variables that may affect those kinds of things. So let's look at the four basic time series models here. There's the moving average model, the weighted moving average model, the exponential smoothing model, and the linear regression model. And I'm going to, since this is an introductory course, we're going to kind of look briefly at these things. We're not going to get too far down into the weeds on this, because a lot of these models of really getting into the weeds itself is something that you would cover in a statistics class itself. But it's important to understand conceptually what these models are, and for some of the simpler models like the first two models is just being able to in essence crunch the numbers yourself. I'm just going to make reference here, and I don't want to spend too much time on this, because for some of you your eyes will start to cross. But when you look at forecasting and you look at statistics, there are certain numerical algebraic formulas that are brought to it, and let me just go through some of the references here. Capital A, alpha, is the actual observation of the variable. F is the forecast. The delta sign is the difference between two numbers. For example, delta AF would be the difference between what actually happened versus what you forecasted to happen. The sum sign is the sum of several numbers, normally in a column or in some sort of sequential sequence. N is the number of observations. So if you're talking about N, that's usually referring to the number of periods. For example, if there's 12 periods in a year, that's usually a month. Years in a decade are 10. Those kinds of things. Also, some other references are T for current time period. Time period can be a measure of any time. Just to understand, it depends upon what you are looking at and how your formulas, your forecasts are brought together. Time could be for 1 month, it could be for 1 week, it could be for 1 hour, it could be for 1 year, whatever that is. T minus 1, just so that you understand here, it's looking for whatever your identified time period is, looking one time period in the past. So for example, if your identified time period is an hour, T minus 1 means last hour. If it's a month, T minus 1 is last month. If it's a year, T minus 1 is last year, etc., etc. And T plus 1 is just the same period looking forward and progressing into the future itself. So let's look at the time series models. As I mentioned to you before, there are four basic categories of model. The first one is called the moving average model. The moving average model assumes that actual sales for some identified previous time period are really going to be the best predictor of the future sales into some time period. And it assumes that what has happened in the past has an equal influence on the prediction of what future sales are going to be. So arithmetically, and again, don't get too caught up here in the algebraic equation, but what it's saying is, let's say, for example, I want to look at what my sales are going to be for the next 3 months. The next 3 months, I'm going to look at what the sales have been for the last 3 months, add those things together, and then divide it by 3 just to get an average, and then I can use that average to forecast what my months are going to be in the subsequent year, well, whether it's a year or whatever the time period is. So it's just an average of what's happened in the past, and you apply that average into the future. It's relatively simple. But whenever you go through and you're using models, one of the things to understand is there's something called a mean absolute deviation, the MAD, which is a tool that is used to measure the forecasting error of a model. So it's really simple to calculate. It really provides you with a method of weighting, determining a weight or an alpha to choose for your model. The weight is just the alpha, which is a factor or a variable that you use in forecasting sales itself. And it really comes up, the mean absolute deviation is just really the difference between what you estimated or forecasted and what actually happened. And how that is arithmetically shown is just with these 2 lines, vertical lines on either side of that. That is just the definition of absolute deviation itself. And so the important part of deviations, of course, is to be able to say, well, just because I've used this method in the past, how reliable, how accurate is it for continuing to use this method based upon what I've actually experienced? So it's what's called the measure of the overall forecast error itself. By taking the actual sales or the actual estimate versus what you forecasted, what the absolute difference was, adding those things up for the time periods and coming up with, in essence, how good or how bad you have been estimating on that. And again, it's just a statistical, and you just need to be aware that exists out there. You'll have an opportunity to play around a little bit on this on the homework assignment itself. The second type of model in the time series model is what's called a weighted moving average model, and this assumes that the closest time period is more accurate predictor of future sales than previous time periods. So, for example, you may be sitting here saying, I want to develop a forecast that goes month by month into the next year, but the last 3 months, instead of looking at the last 12 months of sales, the last 3 months of sales are really going to be a better indicator than just taking the weighted of the last 12 months. But the last 12 months still needs to be taken into account. And so what it does is it really allows you to assign weights to the time periods. That's really kind of based on your judgment. And the sum of the weights, in other words, whatever you're going to be looking at in the past has to equal 100% that you're then going to use to project to the future itself. And so what it really does, and let me just kind of walk you through an example here, is looking at last 3 months of for a forecast. And maybe you look at it and say, well, I'm sitting here and I want to forecast the next 3 months, but I'm going to look at my last 3 months, and October, November, and December. And December is a much better indicator of what's going to happen in the future than October and November, so I'm going to give it a much greater weight. And maybe you're giving it a greater weight because you've come out with new marketing strategies. Maybe you entered a new market. Maybe you're really starting to see a ramping up of a new product introduction that seems to be taking off. And so you're going to want to give more weight in December, but you don't want to just say December is just by itself indicative of future sales. So you still want to give some weight to October and November. And so you just judgmentally you assign a particular of that 100%. You kind of carve it out differently amongst the same periods itself. And then once you get that weighted average moving, then you apply that going into the future itself. A third kind of model of the time series model is what's called the exponential smoothing model. And these start to get really hot and heavy into statistics themselves. And so I'm just going to mention them briefly. The exponential smoothing model it takes a smoothing constant called an alpha as an adjustment in determining the forecast. And a smoothing constant, just so that you understand, is a value that the forecaster will use to adjust a forecast based upon assumptions of sales in one time period versus sales in another time period. And an alpha, this smoothing itself is between 0 and 1, and usually there's it's usually on the lower end of the scale. But the higher the value of alpha, the greater the emphasis given to sales for the current time period. So in other words, instead of it just being the current time period, is you take the average and you apply that to the future, saying there is a correlation and there's a relationship out there to smooth out, and we're going to identify what some of those relationships are and use that as a basis for going into the future. It's very similar in many respects to what's called a linear regression model. And a linear regression model uses, again, a statistical method known as least squared regression. And really what it's doing is it's being even more precise than the exponential smoothing model by looking at more than just one variable, the alpha constant, and it's looking at seasonal variations, trend variations, cyclical variations, and then what's just called random noise, where sometimes you just can't explain why it happened. And you see this in just take for example in Walmart, you're going to have different variations that are going to be based upon the seasons. And every quarter has particular aspects of that season that is going to impact differently. His garden supplies are going to be impacted differently in summer than they may be impacted in winter, depending upon where the store is. Trend variations may be you're looking at new products versus mature products. Cyclical variations may be something that's much more assigned to things that are happening in the economy as a whole or even in the industry as a whole. And then, as I mentioned before, there's noise. As you go through and you do some of these calculations, sometimes you have variations, you have differences that happen, and you go, I don't know what happened. I just can't explain it for some reason. Maybe it was a full moon that night or whatever. We just seem to have all of those sales. And just to show you how this graphically represents itself, you can see that what happens is that if you were to take the squiggly line, that's the actual sales that are being experienced. And you can see that maybe there's seasonal factors in there. There's just kind of a general overall increase. And a regression line goes through and tries to, in essence, use what is the slope? What is the increase that makes the most sense for all of the variables in there? And again, those variables, the ups and downs seem pretty constant here, but sometimes you will have you may have one incident of a huge up and another one of a huge down, and all of those things then would affect your regression line itself, and you have to factor in some of those kinds of things. Again, especially these last two models, can get fairly sophisticated, and usually for the small business owner, they're not going to be using that without using an expert if they really want to use those kinds of models. The third type of model, we talked about judgmental models, we talked about time series models, and the third kind of model that we would be looking at choosing are what are called causal models. And these sometimes are known as external models. They take into account variables in the general economy that can affect the revenue obtained by a company. These kind of models can be very simple, or they can be very complex, usually because there's not a one-to-one correlation on these kind of models, that you have to bring into account multiple regression type analysis, again, usually beyond the scope of a small business manager. An example of this may be that the book references is, for example, if there's an increase in building permits and you own an appliance store, there's probably a relationship to an increase in appliance sales. But again, there's all sorts of different variables because the building permits, there may be differences in how multifamily housing, apartment buildings may impact appliance sales versus single residences. There may be an impact with respect to the kind of building permits that are being out there for large houses versus smaller, more affordable housing. There's just all sorts of different factors to take into account on stuff like that. So when you're involved in a startup business, especially, and you're trying to come up with how in the world do I forecast sales, there's some steps that you're going to take, because a lot of the models we've talked about before have been assuming that a business has been ongoing, that it has a history, that there are certain factors or variables that we can bring into play to really do a better job. But when you're starting up, you don't have that same kind of history to be able to fall back on. So what do? Well, initially you just want to really sit down and in developing a sales forecast, what do you know? What do you really know based upon your experience within that industry itself? If you're not exactly sure on the answers, you should go out and research it. The slide here in the text makes reference to Edgar, which is merely on the SEC, Securities Exchange Commission website, sec.gov. They have information out there on Edgar where you can go and you can look up reports for those companies that are required to submit them to the SEC. If you're a small business, again, the applicability of that may or may not be there. So you just need to use your own judgment with respect to how useful that is. Once you go through and you kind of start to get a better understanding of the industry, you really want to start for your forecast is really start to identify in detail the three types of expenses. You're going to have startup forecasts. What are the funds that you're going to need to put into place initially to open up the doors, to start the business, and to get the business off the ground, so to speak. And this can be anywhere from the expenses with respect to renting a facility. If you're going to have first and last month deposits probably up front. If it's a retail establishment, you're going to have leasehold improvements that you're going to have to factor in as part of that. You may have all of your office and overhead expenses that need to get incurred to go out and buy office equipment. I mean, all of the expenses, even all the way down to business cards and letterhead. You need to think through all of those kinds of things. Then you start to identify what the fixed expenses on a go-forward basis. What are those expenses that are either contractual obligations or are just going to be ongoing, that's going to be there no matter what? If you're renting a place or you own a place, you're going to have utilities that are going to be relatively fixed. You're going to have rent. You're going to have salaries. There are just certain things that are part of your fixed, no matter what you do, no matter how many sales you have. Those are expenses that are going to be incurred. Then there's variable expenses, or sometimes there can also be semi-variable expenses there. But variable expenses are expenses that are directly associated with the sales. For example, if you sell a piece of inventory, a product, the variable expenses, you have to go out and buy another piece of inventory to replace it. So if you never make any sales of inventory, you don't have to buy inventory. But understand that the startup expense is going to be you're going to have to buy some initial inventory. So all of those things you start to really list and you start to put down, and then you really develop a sales forecast. And once you develop a sales forecast, you can then go through and start to prepare pro forma financial statements. And again, a pro forma is just an estimate based upon certain underlying assumptions. And the three basic financial statements are income statement, cash budget, and a balance sheet. And you're really going to prepare these probably in this order. You're going to start off with the income statement. Of course, the first line is sales. Sales is going to very much drive many of your other line items in the income statement itself. And there are some items that it's not going to drive. For example, fixed expenses is not going to drive fixed expenses. But again, there are some items that may be semi-variable that for example, you may rent one truck, but sales are going to be and that's going to be a fixed expense. But then sales hit a certain level, a certain plateau, a certain threshold, which then says I got to start renting a second truck. So that then a second truck gets layered in, which is stays at a constant fix. That's really what's referred to as a semi-variable cost. It stays fixed until a certain portion in time, and then it jumps up. So you're going to pull together an income statement. Then after you have a basic income statement pulled together, you're then going to go back and start to make certain assumptions on cash flow. And again, we've talked about in the past understanding cash flow statements and understanding operating cash flows and financing cash flows and those kinds of things. And you're going to take the component pieces of your income statement. And let's just take one example. Let's assume that you're doing sales and you make the assumption that of your sales, 50% of them are cash sales and 50% of them are credit sales. In other words, you're going to offer credit to certain customers and they don't have to pay you right away. And let's just make an assumption for our discussion purposes that you're giving them terms of net 30 days. So they have 30 days to pay. So as you pull together your cash flow, you're going to want to start to have details in your line items that make estimates on what the impact is going to be on cash. For example, is all of your sales that you make in month one, 50% of them are cash, so you can assume that your increase in cash is going to be based upon those 50%. But the other 50% of your sales don't have to be paid for 30 days. So you want to just take the simplest approach is then the cash for those sales you're going to assume doesn't come in until month 2. And again, once you start to roll this, there's going to be averaging that if you want to get more sophisticated, you can do that. But you can just take the simplest aspect and just assume that none of that cash comes in until month 2, even though you know that some of it may come in earlier. And then as you're going into subsequent months, you then have to start to factor in do some of those debts go bad? Do I have 2% of them I just wind up never collecting? And then you have to start factoring those things in for cash inflows. And as you can see here is cash inflows and outflows, and the timing of that can really have a significant impact on your ending cash balance. Take another example, inventory. You purchase inventory. Let's say you're a retailer or a manufacturer. And your inventory terms are you buy that inventory, and because of your new business, they're not giving you very good terms. Maybe they're only giving you 10 days to pay for it. Well, you buy inventory in month 1, you have to assume that 2/3 of that is going to be paid in month 1 if you're kind of buying it equally throughout the year or throughout the month. So because it's a net 10 days or 1/3 of the month. So that's going to have a different impact on your cash inflow and outflow. And as you go month by month and you forecast out the sales, you forecast out on what that drives down below for the expenses, and then you forecast that to see what the impact is going to be on your cash coming in and out. You then are able to come together with some sort of cash budget. That cash, of course, is then generated and interrelated with your balance sheet, because then you're going to go through your balance sheet and there may be certain assumptions that you're going to make. Let's go back to our example of a truck. It may be that you can't afford to buy a truck, nor do you want to buy a truck. You're just going to lease the truck. And so you have to factor in the lease that may show up on the balance sheet as a debt or a liability, depending on the kind of lease that it is. Some leases are what are called operating leases, which you don't put them on the balance sheet, but other kinds go on the balance sheet. Is what's the impact on that? And when you purchase the truck, you may have 10% down in cash that you have to put on the truck, but then you've got all these lease payments. And so all of these things kind of have to be taken into account between cash budget and balance sheet itself. Are you going to be bringing in an investor that maybe there's going to be an infusion of cash, which in month 3, which you then have to factor in your cash budget, which then impacts your balance sheet. So all of these things become interrelated with each other. And you just have to be sure you document the assumptions that are underlying. One of the ways of coming up with pro forma financial statements, which is a rather simplistic way of doing it, is what they call percentage of sales method. And again, just depending upon the variables that you're going to take into account, many of you will find that this is the easiest way of coming up with a balance sheet forecast, is just the percentage of sales, and then maybe there's just a couple of transactions that you layer in separately on top of whatever your percentage of sales is. And what this basically is it's recognizing that there are either all or a portion of the balance sheet is going to move in the same manner as what sales is moving. So let's say, for example, sales is increasing by 10%. Well, you're going to take that 10% moving of sales, and you're going to apply that to certain line items like accounts receivable itself. And you can even apply it to all of the line items, so that you say accounts receivable, if it represents 2% of my total assets, which I think is what the example that the book uses, 2% of my total assets, then and my sales increase by 10%, then I'm going to take my total assets and 2% of them I'm going to increase by 10%, which is going to impact my AR. A relatively simple moving average of being able to apply to an estimate, sometimes overly simplistic. So as you are going through and you're putting into place all of these pro formas, these estimates, these forecasts into the future, it's important that you understand, as a person involved in a business, that there is monitoring and controlling that needs to happen. Of course, there's monitoring of that, which is by using these financial statements and comparing them to what you have put into place and comparing to the budgets that you've established. Controlling is really establishing from those forecasts a standard, comparing the actual to the standard, and then taking the corrective action that is needed. Now I want to just briefly, because I know the textbook briefly visits this, is just revisiting startup expenses. Again, startup costs you need to take into account, and be sure you have taken into account before you start to really generate sales. It has to be an important part of your forecast. They also mentioned that as when expanding or starting a business, there's a lot of tasks, a lot of moving parts, a lot of things that need to be put into place, and they strongly recommend what's called a Gantt chart. And they give an example of a Gantt chart in there. And let me just very quickly just pull up what a Gantt chart looks like and tell you what a Gantt chart does, because it doesn't have to look exactly like this. It can be something that you do on your own. But what it shows is it allows you to put into one place all of the tasks that have to be performed, how much time that is necessary, if there's a sequential aspect to it. For example, let's just use the example of you're going to go out and have to find a location to do your retail store. Well, your task is going to be to do research on locations, and then that may be task number 1. Zero in on a location. Task number 2 may be to contact the landlord. Task number 3 is to review a copy of a lease agreement. Number 4 is to finalize and sign the lease agreement. And then number 5 is really allows you to start all the tasks of what it takes for you to then get that particular lease maybe there's construction that needs to happen, et cetera, et cetera. All of those things take time. They all have a sequence to them, and you want to understand that if you're planning on opening your doors on January 1st, let's say, and you start to put all these tasks together and how much time it's going to take, you find out that, boy, I need to make a decision and have a lease agreement signed by June 30th, let's say. And that's the only way I can open by January 1st. So if you know that the lease agreement has to be signed and finalized by June 30th, that then allows you to back up and say, when do I need to start this whole process of looking for where my store is going to be? So the next time we get together, next session, we're going to be talking about how to use all of this information here to manage your liquidity, your working capital aspects of the business themselves. Until next time.